When most people think about a rising stock market, they imagine a healthy economy. Headlines celebrate record highs, financial pundits tout wealth creation, and media stories suggest everyone benefits. But the reality is far more complicated. The stock market often climbs even as ordinary people struggle with stagnant wages, rising living costs, and shrinking opportunities. This is the first clue that the so-called wealth boom is, in many ways, an illusion. The key disconnect lies in who actually benefits from stock growth. Stocks represent ownership in companies, and the largest holders are usually institutional investors, hedge funds, and billionaires. When stock prices rise, the top 1% accumulates immense wealth, while the majority sees little change in their financial situation. Meanwhile, the broader economy, jobs, small businesses, housing, and wages, can be stagnant or even declining. This creates a stark contrast. Markets celebrate growth, while the reality on the ground tells a story of struggle. Media narratives amplify this illusion. Positive market coverage creates the impression that a rising stock market equals prosperity for all. In truth, stock prices can soar independently of real economic performance. Factors like government stimulus, money printing, and investor speculation can push markets upward without reflecting the everyday financial reality. This illusion of growth keeps people invested, optimistic, and willing to pour money into stocks, often at historically inflated prices. It fuels the belief that wealth is being created universally, when in reality, it is being concentrated in the hands of a few. Understanding this disconnect is crucial because it reveals the artificial nature of the boom, a carefully engineered facade that masks the growing instability beneath the surface. One of the main reasons stocks continue to rise, even during crises, is the unprecedented intervention of central banks and governments. Through tools like quantitative easing, low interest rates, and massive bailouts, financial authorities inject trillions of dollars into the economy. While these policies are presented as ways to stabilize markets and protect jobs, they often serve to artificially inflate asset prices, particularly stocks, rather than improving real economic conditions. Quantitative easing, for example, allows central banks to buy government bonds or other securities, flooding the financial system with liquidity. This money often finds its way into stocks, creating a surge in demand that drives prices higher. Meanwhile, interest rates remain artificially low, encouraging borrowing and speculative investments rather than productive business growth. The result is a market that climbs on artificial momentum rather than organic economic strength. Governments also step in with emergency bailouts, rescuing corporations that might otherwise fail. While these measures prevent immediate collapse, they disproportionately benefit large companies and investors who hold their stocks, leaving smaller businesses and the general public struggling. In effect, money is transferred upward, reinforcing wealth concentration and widening the gap between Wall Street and Main Street. This combination of money printing and stimulus creates a dangerous illusion. Stock prices soar, yet underlying economic fundamentals, wages, employment, and productivity, lag behind. To the average investor, it appears the market is thriving, but the truth is that much of this growth is manufactured, dependent on continuous intervention. Without these artificial supports, the markets could quickly correct, exposing the fragility of a system built on borrowed and printed wealth. Understanding this mechanism is crucial because it shows that stock market gains often tell a different story than everyday economic realities. The boom isn't purely real. It is engineered and maintained by unseen forces controlling the flow of money. Beyond money printing and government stimulus, speculation plays a critical role in sustaining the stock market's seemingly unstoppable rise. Investors are often driven not by the actual performance of companies, but by the fear of missing out, a psychological phenomenon that fuels bubbles. When stock prices climb, headlines celebrate new highs, and more investors rush in, pushing prices even higher, regardless of whether companies are genuinely profitable. This cycle of speculation creates a disconnect between stock valuations and reality. Many companies today trade at astronomical price-to-earnings ratios, reflecting investor optimism rather than tangible earnings. Tech giants, for example, may see their market capitalization soar while their profit margins remain modest. Retail investors, encouraged by social media hype and financial news, often buy into momentum, contributing to a self-reinforcing feedback loop. The more people invest, the higher prices climb, until the bubble eventually becomes unsustainable. Hedge funds, institutional investors, and algorithmic trading further amplify these swings. Large players can manipulate market trends, taking advantage of retail behavior to maximize gains. Even minor news or rumors can trigger massive buying or selling, creating volatility that benefits a select few while leaving the broader public exposed. This speculative environment masks the underlying weaknesses in the economy. While stock indices may hit record highs, everyday individuals may struggle with job insecurity, inflation, or stagnating wages. The market's apparent prosperity becomes an illusion, maintained by collective psychology rather than solid economic growth. Understanding the role of speculation helps investors and observers see beyond the headlines. The stock market's rise is not always a reflection of real wealth creation. It is often a reflection of human psychology, herd behavior, and the artificial inflows of capital that keep the illusion alive. Without these forces, the so-called boom could quickly unravel, revealing the fragile foundation beneath the market's glittering facade. While stock prices climb to record highs, the benefits are rarely felt by the majority of people. The fake wealth boom disproportionately enriches the top 1%, the investors, executives, and institutional players who already control a significant portion of the world's assets. Ordinary workers, whose wages stagnate and savings erode due to inflation, see little benefit from these market surges. In essence, the stock market has become a mechanism that transfers wealth upward rather than creating it for the masses. Corporate executives also profit immensely through stock options and bonuses tied to share prices. Even if a company's fundamentals are weak, as long as the stock continues to rise, executives can cash out, reinforcing a cycle where short-term market gains matter more than long-term productivity or societal well-being. This misalignment incentivizes companies to focus on stock buybacks and financial engineering instead of investing in innovation, workforce development, or sustainable growth. Moreover, speculative gains in stocks can create a false sense of prosperity across society. Wealthy individuals may spend or invest their gains, temporarily stimulating certain sectors of the economy, while the structural issues, inequality, underemployment, and debt, remain unresolved. Meanwhile, everyday people may borrow, hoping to participate in the boom, only to risk financial ruin if the bubble bursts. This concentration of wealth also has political and social consequences. Those who benefit from the stock market wield disproportionate influence over policy and regulations, often shaping rules that protect their interests while leaving others behind. The system becomes self-reinforcing, rewarding those at the top and marginalizing those at the bottom. Ultimately, the fake wealth boom is less about creating prosperity and more about maintaining appearances. It sustains the illusion of economic health while deepening inequalities, showing that the stock market's gains are rarely shared equally. Understanding this disparity is key to seeing how the system is engineered to favor a select few, rather than society at large. The stock market's meteoric rise is an illusion sustained by artificial forces, cheap money, speculation, and psychological momentum. But every illusion has a breaking point. When economic realities collide with inflated valuations, the bubble will burst, exposing the fragility beneath the glittering facade. Historically, bubbles follow a predictable pattern: exuberance, overconfidence, and ultimately, collapse. The current market shows all the classic signs, from extreme valuations to widespread reliance on continued government support. Once confidence falters, selling pressure can cascade rapidly. Panic selling amplifies declines, wiping out trillions of dollars of perceived wealth in weeks or even days. Unlike the top investors, who can hedge or exit early, the majority of ordinary investors are caught unprepared, facing devastating losses. This not only destroys personal savings, but can also trigger wider economic disruptions, including bankruptcies, job losses, and reductions in consumer spending. Furthermore, the consequences extend beyond financial markets. A collapse could shake global confidence in institutions, exposing systemic vulnerabilities in the banking system, corporate governance, and government policy. It highlights that the wealth boom was not rooted in real economic strength, but in engineered perception and artificial liquidity. For everyday people, awareness is crucial. Understanding that the market is not always a reflection of economic reality allows individuals to make informed decisions, protect their wealth, and avoid being swept up in the hype. The fake wealth boom may continue for a while, but its sustainability is precarious, and the eventual reckoning could be harsher than most imagine.